Hey guys, this is Andy with Team of the Century and Century 21 Everest. Thank you so much for joining us today. We interviewed Dan Hubrich with Castle Cooke Mortgages and talked a lot about the differences in loan products that are available out there, if it's a good time to buy right now, and what it takes to get pre-qualified and pre-approved for a loan. From there, we talk about rental properties and different types of people who are needing to get approved for self-employment, all of those types of things. Agents as well as buyers and sellers are going to get a ton of information out of this interview. If you have any questions or comments, we would love for you to post them down below. Thanks so much, guys. Dan, thanks for showing up today and coming down, man.
Yeah,
it's been an interesting thing doing these interviews. I've really enjoyed it, so I'm grateful that you're here.
Yeah, it's good. Thank you.
So before we get into it, we want to talk about all the different loans and everything that you guys do. Wanted to know a little bit about Dan and why loans and what you do for fun and kind of that stuff. So in talking to Clint, he talked about that you're, I guess in lending, it's President's Circle. I don't know all of that stuff.
Yeah.
We don't have that in real estate, so that I know of.
Right.
At least I'm not there yet. How's that?
They need to get it.
Yeah. So what is that? Share that with us.
So the President's Club is just for the top producers every year. They put together a really nice trip. And so I've been every single year. I've made the trip. So this will be the 6th year in a row.
Sweet. So you've been a lender for 6 years?
Well, I've been a lender for 13 years.
Okay.
6 years with Castle Cooke.
Okay. So every year with Castle Cooke.
Every year I've been with Castle Cooke. I've made President's Club, and they have requirements. You know, it's generally the top 20 loan officers in the whole company.
Wow.
So you have to have production.
Yeah.
Obviously.
A lot of production.
Yeah. Right.
Yeah.
And so, it's fun because it's obviously we're working hard anyway.
Yeah.
But it's just one more thing to try to make the trip. And so they've taken us to Hawaii every year.
Really?
Yeah, and it's all out.
That is cool.
Yeah. So this year we're going to Mexico though. So.
Oh, cool. Okay, so something different this year.
Yeah, so it'll be fun.
They just started doing that. So Century 21 just bought a company in California, and that was one of the things that they did. So now instead of getting rid of it, they've added it now to Century 21 here. So we don't know all the requirements yet, but there's going to be a big trip for the top producers. Yeah. So I'm pumped.
It's cool that companies do that.
Yeah.
It's just I think it improves morale and
exactly.
It's just something to get excited
and the competition is always fun.
Exactly.
That's the best part for
Absolutely.
me. I don't care about the trip.
Absolutely.
I want to beat everybody.
Yep.
So, and then I always make fun of your posts when you do this. I apologize, but you do all these bike rides and stuff, like serious, like holy crap kind of stuff. So tell me about that. There's a lot of you really go for it.
Yeah. So I do a lot of cycling. Exercise has always been a big part of my life. And we're in a stressful business. Let's be honest. We're dealing with people's homes and finances, and there's a lot of pressure to not screw up.
Yeah.
And so
that's true.
So you need an outlet, right?
Yeah.
And so for me, exercise has always been a healthy outlet, and so I do a lot of cycling. I'm a weekend warrior. I'm not professional by any means, but I've done the Lodija is the Logan to Jackson 200-mile one-day bike ride. Done that 4 times.
Really?
And so that's kind of my big race that I train for every year.
That's awesome.
Yeah, it's a lot of fun.
Wow. So so you have kids, and
Yep.
What do you guys do for fun? What's family fun?
Yeah, so we love to go boating, hiking. We love the outdoors a lot. We go to St. George a lot.
Nice.
Try to get out of the... So, yeah, we like to get out, and...
That's cool.
Yeah, we're a really active family. So
nice. That's awesome. Where's your favorite place to camp?
Well, we're not big campers. I didn't say that.
No. So it's outdoors, but just for the day.
My wife's requirement is if they don't have a mint on the pillow, then we're not going.
Your wife and I share a common bond here because I don't want to do that
I'll
either.
go camping, but it's not really a family thing. We're more condo people.
Yeah, I'm with you. So with you on that. I don't know if we've ever taken our kids camping. I don't think we ever have.
Funny.
Yeah, it's not my thing. We have all the gear. We bought it a long time ago, and it's still in the package.
I love everything except the sleeping part.
Yeah, exactly.
I have claustrophobia, and I get a sleeping bag, and it's no good.
Yeah. I hiked to Kings Peak once, and that cured me of all of that kind of stuff. That was enough. My brothers make fun of me all the time, but
nice.
Yeah. So, all right. Well, let's talk about lending and what's going on. Why... So when we go out and prospect, a lot of people, when we get to the point, they want to go look at homes, they want to do all this stuff. And then I say, well, we need to talk to a loan officer first. Why are people freaked out to talk to loan officers? Because I know what happens.
Right.
But what is the common thought out there of why people are freaked out by it?
Yeah, I think people, I mean, if there's two different types that we see.
Yeah.
Right? If someone knows they're buying a house, it's never an issue.
Yeah.
You know, we don't see any concerns.
When they're serious, they're ready.
But I think a lot of people might be tire kickers, we call them.
Yeah.
You know, just like in the car business, where, hey, I want to see what's out there. I want to maybe get an idea. You know, we're kind of toying with the idea of buying versus renting. We're not quite sure. Those ones, there could be some hesitancy.
Yeah.
Because, you know, there's quite a process to get pre-approved and to do that. But it's in everybody's best interest.
Yeah.
They're wasting time if they can't actually qualify.
It's so true.
They're wasting your time if they can't qualify. And so it's really just something that has to be done if they're serious about looking.
For sure. What we find is, and this happened especially early in my career, we almost won't take anyone out now if they haven't been pre-qualified. Right. It's pretty rare.
And I think that's generally speaking, a very good rule for
a
realtor.
Well,
just because your time is precious.
It is, and it's not whether or not people can buy or not, or they're not going to qualify. It a lot of times comes down to they want to go look at kind of the Taj Mahal of where their upper end is, and they're $400,000, but they only qualify for $3,000, and you can't compare those two price ranges. But it happens, and so it makes it so tough. Yeah. So getting pre-qualified is huge. So you say there's a bit of a process. What's the process of getting pre-qualified?
So the first thing we do is I like to just have a conversation and just find out what they're doing. You know, it's like, hey, where are you at?
Yeah.
Because that's when you're going to find out, you know, their temperature. It could be, hey, our lease is up the end of the month.
We got to go.
We need to go now.
Yeah.
Or it could be, hey, we got 6 months on the lease still. Or we own a home and, you know, we want to wait till the school year's over and we're just trying to get some ideas, you know. So the first thing we do is just have a conversation, see where they're at. Because I'm super easy to work with. I'm not going to push anyone if they're not ready.
Yeah, if you're not, you can't sell the unsellable.
If
it's not worth
says, hey, we're waiting until the school year's over and then we're going to sell. I mean, there's no sense in doing the whole shebang, right?
Yeah, exactly.
But if they're saying, hey, you know, this is where we're at and we're ready to go, at that point, once we've talked about the plan, and this is the thing I love about this business. It's different for everybody.
Yeah.
Right. Yeah. Every scenario is different. You know, and so that's why we've got to have that initial conversation, just so I know what's going on. Do you have a house? Are you selling it? Are you keeping it as a rental property? Are you a first-time buyer? You know, you got to learn all of that stuff.
A lot of people don't know that those are options that you have.
Exactly.
So you don't have to sell your house in order to buy one.
I mean, the best analogy is the doctor. If you go to the doctor and just say, hey, I'm in pain, he doesn't say, well, I've got the solution, right?
Yeah.
The next step is more questions.
Yeah.
Well, where do you have pain? And what's this and what's that? And it's a conversation and then the diagnosis.
Yeah.
So we like to run our business the same way. Once I know what your plan is and what you want to do, then I can offer the best products and we can
tailor
go
it
to
for
the
each
next
person.
step. Right.
That makes sense. So they go, what do they have to bring to you guys? You had the first conversation. Yep. There's okay, so let's back up. What's the difference between a pre-qualification and a pre-approval? Because I think the things that people have to bring to you are going to be very different.
Correct,
and which one's better?
That's actually a really good question. So the first thing we do, no matter what, is get the application.
Yeah.
So in the application is just all the basic information. Who are you? Where do you work? How much do you make? What debts do you have? All the basics that we need, and then we have to check the credit, see where you're at, right?
Yeah.
So if I've done all of that, I can technically issue a pre-qualification letter, which just says, hey, based on everything I've seen, you should be good to go. Now, we don't like to do that because I've got to verify income. You know, what if there's overtime? What if there's commission income?
Yeah.
What if there's self-employment income?
Commission income and a loan.
All of these things can be a major red flag or not necessarily a red flag, but it can change the scenario
for sure
dramatically.
Yeah.
So we try to stay away from pre-qualifications just because it's the simple way to think of it is it's a quick first look.
Yeah.
Okay.
It seems like kind of like what somebody is, you really have to base that off of what somebody's told you, not what they've proven to you.
Correct.
And they're not always the same thing.
Right. Now, and here's the thing. Let's say someone calls me on a Friday night, running out the door to go to a movie with my wife, and they say, we want to look at homes. I got to know at least where we're at, right?
Yeah.
So if I take a quick application, run credit, and everything's just rock solid, I'll issue a pre-qualification and say, hey, I don't see anything wrong with this file. But before they make an offer, I'm going to insist on getting pay stubs, W-2s, all the stuff we need to make 100% sure. Because we don't ever want to send you out looking at homes. And it's a disservice to everybody. It's a disservice to the borrower if you get them excited and then there's a bump in the road later.
Oh, yeah, and it puts a sour taste in their mouth. It's not fun.
It's not a bad thing. Everybody wants to know that it's a solid deal.
And on top of that, for the sellers, when you get an offer that's a pre-qual versus pre-approval, it matters. Like, if it's the same, even if the pre-qual is a little bit better of an offer, we have to, as our job as a real estate agent, explain to our client, look, there's a difference here. These aren't exactly the same type of thing.
Right.
They're definitely not the same.
Yeah.
So that brings up a question for you. One of the things that we do is so you have your FHAs and you have your conventional loans. Those are seem to be the two ones that we always get.
Right.
If we were to get two offers that were very similar, we would actually end up going with the conventional versus FHA if they're close. Do you agree with that? Are they typically easier to close?
Not necessarily. The underwriting process and the approval process is pretty much identical.
Okay.
The reason FHA holds a little less weight when you're the seller is because they're more strict on the property itself.
Yeah.
As you know.
Oh yeah, the repairs.
In that respect, they're a little higher risk because if you run into an issue with the house, that's got to be fixed before closing. Versus conventional wouldn't care.
Gotcha.
But as far as the actual qualifying and closing of the loan, it's identical on our.
Oh, really?
Yeah.
Okay, so
they're just as easy as any other deal.
Are there things I've seen some really exciting, not very well built homes that are out there, and they end up still getting approved on appraisals and things. What kind of repairs that would be necessary? What kind of repairs that you and I going out looking at home? Well, this has a hole in the wall to the outside. I can see the outside from the inside. That's not good. Right. But I've had it not get flagged on a conventional loan. Is there a real hard and if you're not 100% sure, because I know that's kind of an appraiser maybe a question. Is there certain things you see that repairs that don't get done? Yeah, FHA does.
Are you talking about conventional or FHA?
Conventional.
Oh, okay, yeah. So conventional is a lot more lax on what they'll let slide.
Yeah.
However, the simplest way to think of it is unlivable conditions.
Yeah.
So a hole to the outside problem.
Right? You would think,
I had one actually. The appraiser says, I can see dirt inside, like the dirt floor. So we need that covered.
Yeah. Get a rug, something.
Yeah, I can see I can see the actual lot.
Yeah. Oh my goodness.
So unlivable conditions.
Yeah.
Right? So that's the main thing with conventional, and obviously there's a more specific list that I can get to you.
Yeah,
but they're pretty flexible, right?
Yeah.
FHA is going to be a lot more strict, where hey, we're missing a light cover, or there's a tear in this screen, or the broken window, or a missing railing, like all these little things
they're
could get flagged. Right?
Yeah,
so a lot more strict.
Not ticky tacky. They're important things, but conventional is if you're selling a home, you'd go with a conventional. They're very similar offers.
But again, just think of the big stuff, like it's falling off the foundation. Obviously, conventional won't like that either.
Yeah, they're not going to be. We actually had a house that we went in and listed, and we sold, but it was a private sale, went all cash because of some of these. The owner had dug out the floor in the basement and built a room under the house, a dirt room, like it was like a 15 by 15 dirt room in the house.
Permits or anything?
Nothing at all. Originally, he had dug it out to replace a pipe that was under the house. And so that was one of the things we're like, you're going to have to fix this. We can't sell this like this. And we sold it to an investor, and they knew about it. So hopefully everything got done right. But it's sketchy sometimes out there for sure. Okay, so we talked about the difference between pre-qual. So you said that if they're going to get pre-approved, they need to bring pay stubs, tax returns. What's
Correct.
all kind of like a short list of that?
Yeah, the short list is we need 2 years of W-2s.
Okay.
We need the last 30 days of pay stubs.
Okay.
We need the last 2 months of bank statements.
Okay.
To show where down payment and or earnest money is coming from. Any retirement statements you're going to want. Now, we're a direct lender for Fannie Mae and Freddie Mac, so we're a little more lenient than other lenders.
Gotcha.
And so we generally don't need tax returns unless they're self-employed.
Okay.
So that's really the main stuff. Now, based on the circumstance, there will be more for some people versus the others. So, for example, you had a bankruptcy. We've got to get the bankruptcy documentation. Okay.
Now, is that if it's ever happened you had a bankruptcy?
No,
or is that
only
just
within the time periods.
Okay.
So, for example, FHA, if it's within the last 3 years, we've got to get. I mean, really, let's put it this way: if it shows up on credit, we have to get.
You need to know
just to verify the dates.
Gotcha.
Okay. If it's fallen off of credit, we don't care.
Gotcha.
Okay. But divorce is another big one. Okay, we got to get a copy of the divorce decree.
Okay.
Because that can definitely affect qualifying.
And does somebody read through that divorce decree?
Yeah,
you have an underwriter, or?
I mean, I read through it.
Oh, do you?
Yeah, because I don't. Again, I'm not going to put my stamp of approval on it unless I know it's a deal that's going to go through. So yeah, we're very familiar with those, and And it makes or breaks a deal.
Yeah, for sure.
You know, like, oh, I didn't know you paid $1,500 a month in alimony. Oh, well, I thought you just wanted child support.
Yeah.
It's like, no.
They're not
all financial obligations, right?
Yeah. And
so
happens.
that's why we need all that stuff.
Yeah, and that happens because you have to be able to prove that out. And I've seen that happen a lot where there's surprises. Not surprises that weren't asked for, but surprises to us because we wouldn't know them at the time when we went out to go do stuff.
And that's a good example of one that we wouldn't know unless we asked or they told us.
Yeah.
It doesn't show on credit anywhere.
Alimony doesn't at all.
Yeah, that you pay child support or alimony.
Gotcha.
And so that's part of that process where we dig into it, ask the right questions, and that way there's no surprises later.
Gotcha, okay. Okay. Trying to think of what else. So one of the things that we've found in our experiences, why does someone, so let's say they get pre-approved, they get the full pre-approval and they're done. Why would they not be able, and they go under contract, why would they not be able to get the loan? What could happen between getting pre-approved and everything's great,
basically?
Yeah, gotcha. And then closing. What are those
this
things?
This is where an experienced loan officer is going to catch things versus an inexperienced loan officer.
Yes.
Okay. So when any lender does the pre-approval process, we're going off of Fannie Mae and Freddie Mac guidelines. Okay. Because at the end of the day, almost every loan's going to end up there.
Yeah. Conventional
it doesn't
FHA
matter where you
doesn't
go.
matter.
Yeah. Chase, Wells Fargo, you could be one of these huge lenders. At some point, they're going to package those loans up and sell them to Fannie Mae. So because of that, we all use Fannie Mae guidelines. Okay. So let's say let's give an example, lender A versus or inexperienced versus experienced.
Okay.
So we have these ratios that we can go up to. Okay. So for example, on a conventional loan, you can go up to 50% of your gross income debts. Okay, your debt ratio.
Total debts.
Yes, you make $5,000 a month, you can get a house and have all your other debts equal $2,500 a month.
Including the house.
Including the house, right? Okay. So that's gross, right? FHA will go even higher. Okay, we can go 55, 6, 7.
Wow.
Depending on the scenario. And so an inexperienced loan officer would say, hey, I've got you pre-approved, and they'll max that thing out, right? So technically speaking, it is pre-approved, but if you sneeze, that thing's not going to qualify, right?
Yep.
Seriously, I mean, I've seen scenarios where, another loan officer botched the deal because the taxes were higher. It's like, they squeaked them in at the pre-approval, but then taxes were $50 a month higher, or maybe they didn't account for an HOA or something.
And that makes a big difference.
Now you don't qualify.
Yeah.
Right? Or another one, sometimes you have to have reserves, a little cushion in the bank. Okay? Maybe that client had it when they pre-approved, and then they spent it, and now they don't.
We had that exact thing happen. We had a gentleman who ended up buying a car. He paid cash for the car. Now he doesn't qualify for his loan because he didn't have that
exactly
cushion.
Even though it wasn't on his credit, he used up that money.
Yeah,
that was part of the original pre-approval. So to avoid all of that, there's a couple things we do. We have, again, this is all part of that initial conversation. It's like, hey, if we're doing this, here's the new rules.
Yeah, exactly.
I'm your boss, and when I say jump, you say how high.
Yeah.
All joking aside, there's very specific things. You don't want to go buy any new things on credit.
Yep.
Don't change your job. Don't reduce your income. Like all these things, they've got to be very careful about.
And we found that even going to like a carpet company and buying the carpet and just having them hold it can show up on your credit.
Correct. Yeah. Any inquiry at all. You don't necessarily have to close on the deal.
Yeah.
Any inquiry at all is going to be reviewed by underwriting.
Yeah, and it can really mess stuff up. So if you're going to do that, or if you're going to buy a house, don't buy anything else on credit. Don't spend anything abnormal. Just keep it
now. The second you close and you're in the house and funded, we don't care what you do.
You go buy, and it'd be much easier to do afterwards.
Exactly right. So, and the other thing that I do, and this is again experience, I like to call it leaving a little meat on the bone.
Yeah.
So
you mean you don't want them to be house poor.
Exactly. So let's say technically we could push them to a $300,000 loan, but that's maxing them out, and like I said, you sneeze and you don't qualify. I'll send that out at $290.
Yeah.
And not tell anybody.
Yeah.
Right? And it does a couple of things. It protects them.
Yep.
It makes it to where we're going to go through underwriting without any problems because I've got a little cushion. And it's a huge benefit to you because what if you call me and say, Dan, we found the perfect house. It's only a little over what they qualify for.
Yeah.
I'll be like,
they got multiple offers.
Yeah, I'll be like, wink, wink, you're actually good. Go ahead.
Okay.
Versus it's a deal killer.
Yeah.
Because I maxed it out initially.
That makes
and now they're upset or frustrated. You've spent all this time, It
happens.
We just want to avoid all of that.
Yeah, it's happened in the past. So that makes perfect sense. Okay, so this is kind of a general question. What are your thoughts about the real estate market and the lending market? It seems to be, so every conversation I have is we've been on such a big run for so long. There's got to be a correction, which makes sense, right? I can appreciate that. But it seems that I'm starting to hear people say, well, we're going back to if you can fog a mirror, you can get a loan. And so talk about that. What is it that easy? Is it?
No,
are we going to be good?
It used to be. 10 years ago, before the market crashed, it literally was that. We had stated income loans where it's just
which
like
is crazy. It sounds crazy.
You tell me what your income is. Like, who came up with this idea?
Yes.
Right. They had even worse than that. It was called no doc loans, where we didn't want to know anything. Like, don't tell me where you work. Don't tell me how much you make. All I need is your credit. Yeah, you're good. No income statements, nothing. Wow. Yeah, and so no wonder everything fell apart.
Yeah.
You had people buying homes that had no business buying them. They couldn't afford them in real life. And it was literally hot potato. The market was so nuts. People would say, yeah, I don't care if I can afford the payment because I'm going to flip this thing and make $50,000.
Yeah, I'm going to buy this and turn it and I'm going to make money.
This all worked until it didn't work.
Yeah. Oh my gosh.
So we haven't gone back to that.
Good.
Okay?
I know
everything,
that.
Yeah, everything's full doc. You've got to have, prove your income, prove everything, right?
Yeah.
Now they have loosened up quite a bit. Okay. So we have zero down products, for example.
Gotcha.
And credit requirements have loosened up. Okay. Debt ratios have loosened up. So yes, it's looser than it was after the crash, but we're definitely not anywhere compared to 10 years ago.
Yeah, and I've noticed that because we still have people that get turned down for loans because it happens. You go and qualify, or you try to qualify, and they get turned down. Where I wasn't in the business back then, but I heard like it was.
Yeah, I was there. It was
the
nuts.
Wild West.
Right.
if you wanted a loan, you were getting a loan.
It was crazy.
That's rough.
Well, and it was extreme pendulum swing.
Yeah.
After everything fell apart.
No one
then
cared.
Then it was like, we need your left arm, a blood sample, your firstborn child, right? It was crazy. So I think we're in a perfect spot.
Gotcha.
Where it's not ridiculous, but it's not so hard that you can't get a loan.
Yeah,
right?
gotcha.
So most people will qualify nowadays.
Yeah. So what happens if somebody doesn't qualify? So, I mean, credit scores, income, all of those types of things. So if they don't make enough income, obviously they need to make more.
Yep.
But I mean, if they can pay down their debts or credit scores, what do you do when someone doesn't qualify,
Great
but
question.
they make good money?
And this comes back to the experience piece, right? So I've been doing this for 13 years. I was a realtor before that, actually, in the business for 20 years as an investor. So I'm very creative, okay?
Okay.
Creative is a dangerous word
Yeah,
in our business.
It can be.
Back in the old days, loan fraud was called creative financing. We don't do that.
Can't do that anymore.
We don't do that. So we have our guidelines, but when I say creative, the inexperienced lender would say, "Oh gosh, you just got too many debts. You don't qualify." I would look at that same scenario and say, "Guys, let's figure this out."
Yeah.
You're paying $200 a month on this $6,000 credit card. You've got a car loan here that's $300 a month. Okay, that $500 a month is not allowing you to buy about $100,000 worth of house.
Is that about what the ratio is right now?
Yeah, it's every $1,000 is about $5 to $6 per month.
Okay.
So if you have $600 in miscellaneous debt, that's about $100,000 in house that you could buy.
Wow.
It's a huge difference. Right?
Yeah.
So what I'll do is I'll say, the first thing is let's get rid of that debt.
Yeah.
Right.
Pay it off. Sell it.
Let's say someone's selling a house, and their plan was to put all the money to the down payment. Well, in this scenario, I would say, let's pay off this miscellaneous debt, and now you can afford a lot more, and maybe even get a bigger house for less than you're paying now between everything.
Yeah, because a 30-year loan versus your 6-year loan on your car, your payment's a lot less.
Exactly. Or let's say they don't own a home and they don't have a lot of assets. There's still things you can do. We can say, hey, how long have you had this car? Oh, I've had it 3 years. Good grief. Rates are so low right now. Let's refinance it. A car loan doesn't cost anything to refinance. Yeah. They can do it in the same day.
Yeah, and it's done. So you can do a car loan in the same day.
Yeah, so we could refinance. Let's say we drop that car loan from $300 to $200 a month.
Yeah,
I mean, again,
that's a lot of money.
That's another $10,000-$15,000 in house you can buy. Right?
And that same thing, it will go back to fixing someone's credit, but that same thing transfers to HOA. A $100 HOA is now $10,000 to $15,000 of house.
Correct.
Okay.
Yep.
Okay.
Yep. So, and I'm glad you brought that up. When we issue a pre-approval, it's assuming a single-family home. Okay? Mm-hmm. Now, that doesn't mean they can't buy a condo.
Yep.
But I always have that conversation. If you're going condo, you got to tell me what the HOA fee is immediately before you make an offer, because that's going to come right off the top.
Yeah, and then they can use a ballpark if it's $150 a month, and now you got to come down $20,000.
Correct.
Okay. So they can they can go through and do some of that. What if their credit score? So that's their debt to income ratio.
That would be the debt ratio to qualify for more. Let's say they don't qualify at all.
Yeah.
I mean, obviously, we still have, even though things have loosened up, we still have our minimums.
Yes, which I'm grateful for. It keeps the market healthy, people in the right house.
And just so you know, 620 is the minimum for conventional.
Okay.
And for zero down. Okay. We can go down to 580 on an FHA loan.
Gotcha, so but it's not zero down. You have to come with some money.
They've got to have their own money, 3.5% down if they're below that 620. So let's say someone's 570. Okay. They're close, but they're just not going to qualify. There's a couple options we can do. The easiest is, let's try to fix some credit issues, right?
Okay.
And oftentimes it's not as hard as you think.
Yeah.
Now, if someone's 400, they're going to need a lot of help.
Yeah, it's totally different scenario. 10 points, 100 points. Exactly. They're not
low 500s. We'll send them to one of our partners. It's a credit repair company, and they do the whole 9 yards, right?
Gotcha.
But here's the thing you got to remember about credit. There's no personality behind the credit algorithm, right? It doesn't know who you are.
It doesn't matter who you are.
You're a nice looking guy. It doesn't give you extra points for that. It's all information in, information out, right?
Yeah.
So literally, it looks at the good accounts compared to the bad accounts and spits out a score. And there's all these different things in the algorithm. Longevity, how much are you maxing out your credit cards, So it's very custom to each scenario.
Okay.
But an easy method is, let's say you have 6 accounts.
Okay.
3 of them you were late on.
Yeah.
Well, guess what? If you go get 2 new accounts, now that ratio is lower.
Oh, really?
See what I'm talking
Something
about?
like that.
Yeah. So
even though everyone's brain, you're like, oh, you're going to get more credit. That should make you less credit worthy.
Exactly. Doesn't that sound crazy?
But it works.
Correct, because you're kind of manipulating the algorithm.
Yeah, which I think everybody does as much as they can.
So now the computer says, oh, you've got 5 good accounts and only 3 bad ones. Your score went up 20 points.
Oh my gosh.
Or another trick is to pay debt down. This is actually a really powerful one to boost the credit. So again, this is so silly, but let's say you have a $5,000 credit card with a $5,000 limit.
Okay, so you're 100% maxed out.
Correct. If that same credit card had a $10,000 limit, your score would be better.
Gotcha.
Because it's the percentage of the use or of what's available.
Yeah.
So and it makes sense. Think about it. You've used 100% of what we gave you.
Yes.
It says you're not very responsible, right?
Something's happening. Yeah.
You see what I'm saying?
Yeah. Emergencies, those kind of things are running your life.
So paying down those balances. There's all these little tricks we can do to get a quick 20, 30, sometimes even 50-point credit bump.
Gotcha.
To where now you do qualify.
Okay.
And so we do that for free. We just educate people, give them a few tips.
It's just part of the deal.
Yeah, but like I said, if it's really rotten, we're going to have to spend some time, spend a little money.
Do you see now? Some people get into those situations, and life happens to people, and that just kind of sucks. But it does, and so people work through that. But do you see a lot of those people that you end up sending to a credit collection company? Do you see a lot of them come back out of it, or is it the reason that their credit score is low is because of their? It is a habit, right?
Correct,
For a lot of those people, it's not going to be because of that.
Right.
Gotcha.
So. Yeah, the percentage, if it's really, really bad, the percentage is pretty low.
They come back out.
And they can fix it if they'll do what they're asked.
Yeah.
Right, but like you said, there's a reason.
There's a reason they're there.
Place,
yeah.
Here's another thing to think about. If you're really just struggling and there's just no way to dig out, it's actually better to file bankruptcy than to try to keep fixing the old credit.
Yeah.
Because it kind of wipes the slate clean, and you can get into a house as little as 1 year. But in most situations, 2 years after.
So is that a Chapter 13 versus 7? Correct. I wanted to talk to you about that. What? Yeah. So tell me the time frames. Like once someone has, and one of the things I've found out, and we've talked about is, so on a Chapter 13, you're making you file bankruptcy, you're renegotiated your debts, and now you're making payments to the state, the trustee, and he's dispersing it. Correct. Or she is dispersing it. And your time frame that you're going to give us starts from the day that it was discharged, not the day you finished paying all of your debts.
Correct.
A lot of people, and a lot of people I know, they've been paying on their Chapter 13 for 5 years. They're like, well, then I have to wait 2 or more years after I. No, it was when it discharged originally and you started making your payments.
Exactly.
So
on a 13, we only need 1 year of on-time payments to the trustee.
Really?
And then they can qualify for a house.
Now, you have to get a permission from the trustee,
Correct.
right?
Correct.
You got to talk to
so
them.
It's a little more tricky on the pre-approval process.
Yeah.
You know, we'll do our normal thing.
Yeah.
But then it's on hold until they get permission from the trustee.
Yeah.
But in most cases, they're going to allow it.
Yeah.
You know, they want them into a house. That shows more responsibility.
Exactly.
They know it's going to help their credit. And if the payment's not that much different than now.
What's the difference then? So you got 13 where you go through that 1 year, and there's some stipulations, but 1 year. Mm-hmm. What about a Chapter 7?
Yeah, so the difference on a Chapter 7 is rather than renegotiate the payments, they're just paying everything off. It's just wipe the slate clean,
completely gone,
walk away, and start over.
Yeah.
Right. And so in that case, you wait 2 years. Okay, now you can do an FHA loan.
Okay, so and that was my next question: is there different types of loans that they will do for someone who's in that situation that's been so recent? Like, can you get a conventional? Is it money talks? Like, if you have enough
Actually,
down,
that is true.
You can make it happen.
Yep. So a tip. Well, let me explain.
Okay, yeah.
So FHA will allow after 2 years on a Chapter 7,
okay,
or 1 year on a Chapter 13. Okay. Foreclosure is going to be 3 years with FHA.
Okay.
It's a little bit longer.
So it actually is more significant if you foreclose.
Correct.
In order to buy a house.
Correct. Yep.
Okay.
So foreclosure is going to be 3 years. With conventional, it's even more strict. 4 years from a bankruptcy and 7 years for a foreclosure.
Wow.
Before you can do a conventional loan. However, there are boutique banks that we work with that they don't sell their loans to Fannie Mae. They just keep them in-house, and they have different guidelines. Okay.
Yeah.
So back to the money talks question. There's situations where maybe you're a business owner, right? You hear the story of, my partner ran off with the money, whatever.
Yep.
And now I had to file bankruptcy, but he's still, he or she's still a great person. They've got other assets. They could actually do it with no seasoning.
Really?
So, yeah, if you've got 10 to 20% down, depending on where your score is at, we can do a deal right now if you filed bankruptcy last week.
Really? So money talks in the end.
Correct.
Because you can find a more private lender who can do something.
And we've got all those setups. Okay?
Gotcha. That's awesome.
Now, think about it. You're going to pay a little bit of a price.
Of course, your interest rate's going to be higher.
Rate's always going to be 2 to 3 points higher than normal. But, you figure into the calculation, prices are going up. You're paying down that principal.
Yeah.
Do the math over 2 years. Even with that higher rate, most of the time, it's still a better deal than renting and waiting.
Yeah, and then you refinance out, and you get to a normal rate, and you now have still paid everything down.
Yeah, the easiest way to think of it is, what if the house you want today is $50,000 more in 2 years?
Yeah, it's going to be a lot more.
You're not paying $50,000 extra with that couple of points.
Not a chance.
And so that's a way to look at it.
Gotcha. Okay, gotcha. Let's see what else was on here. Okay, this is a good one. There's a misconception, I think, with FHA loans, and maybe I have the misconception. You can do an FHA loan multiple times. It's not just a first-time home buyer's assistance program. Right. You can do this. You can't carry more than one at a time, but you can use that program. Is there a very specific first-time home buyer's program that really is for the first time you've ever bought a home, and what's the differences?
Yeah, good question. So, like you said, FHA, you just can't have more than one at a time.
Yeah.
So I can have an FHA loan now, sell it, get another FHA loan. I can do that over and over.
Yeah.
Okay? Down payment assistance is a little bit different. It actually works in conjunction with an FHA loan. So on FHA, you've got to have 3.5% down.
Okay.
And they're flexible on where that can come from. It can be your own money, retirement, even from family, or a combination. Let's say you don't have any of that. Well, we can do the normal FHA underlying loan, and then we have down payment assistance programs where, depending on the situation, it's either a second loan that equals 100%, or it can even be a grant where you don't owe anything,
awesome.
Right?
Yeah.
And so that's the difference. And if you're a first-time buyer, oftentimes you'll qualify for that down payment assistance, and they'll give you a little break on the rate too.
Oh, really?
Yeah. So there's definitely advantages to buying a house for the first time.
Yeah, and it incentivizes people because I think that we know that it's a stronger economy, a stronger community when people own their homes versus rentals.
Yeah, and people say, why do they do that? Why would they do that? Well, think about it. You buy a house. What's the next thing you buy?
Car. You're going to buy
Stuff.
a boat. Yeah.
Right?
You're taking care of the yard.
Now I need a snowblower. Now I need this. It helps the economy. Right?
Yeah, and you're incentivizing someone, the city, the state, the government, is incentivizing you to take care of your little spot. And if everybody takes care of their little spot, we're good. So there's an incentive to have a little spot.
So it's a win-win for everybody.
Yeah, that makes perfect sense. FHA, and when we talked about this, I wanted to bring this up on a video format, but we talked about it on Facebook.
Oh, yeah.
You can So when you use an FHA loan, no matter what you're doing, you have to have in the intent to live there for a minimum of 1 year. Now, I've seen it where they've left earlier than a year, but you can't buy a house knowing you're going to move in 3 months and flip it.
Yeah, that's
but you can get in trouble for doing that kind of stuff. But if you know that you're planning on living there for a year or more, and then you want to go buy another home and you keep this first home as a rental property, you don't have to refinance out of this home. You could. It might make sense to buy your second home with FHA. Who knows what the situation is.
Right.
But you don't have to sell that, right?
Correct. Yep.
You can keep that.
If you've lived there for a year, you can now convert it to a rental, which in my opinion is the best way to acquire a rental property.
Yeah.
Because normally you'd have to put 15, 20% down.
Yeah.
Now it's 0 down.
Yeah, and you're
just
in.
Walk away, and now you have a rental property.
Yeah.
Right. Now you'd have to income qualify.
Yeah, for both
with 2 homes, and we could talk about that. But 1 year and you're good. In fact, I've done it
yourself.
I have a rental property right now that has an FHA loan on it.
That's awesome.
That I used to live in a long time ago.
Okay, gotcha. And so it can go for the whole time. There's no...
Yeah.
Okay, so I have 2 questions about FHA loans, or one question about that, and then I want to go back to the income qualification with 2 homes.
Okay.
And I just lost it. FHA loan.
Something about renting or...
No. I'll have to come back to it. Okay. I can't remember. Dang it. I had it. Okay, so for the income qualification, so let's say you have this first home that you've owned for however long, and you qualify to buy a second home, and you're planning on renting this first home. Is there any way to include any of the rental income as part of your income, even though you haven't rented it technically yet?
Yep.
To do that, if so, how do you do that? What do you need to do?
Yeah, really good question. So you can, the easiest way is you just make enough money to qualify for both. But
gotcha.
That's going to be the exception. Most people are going to need to have some other offsetting income.
Yeah.
So if you have a signed lease, for someone taking over your house as a rental, then we're going to count 75% of that right off the bat.
Gotcha. And why 75%?
It's just Fannie Mae's guideline, FHA's guideline. So, but that in most situations that covers the bulk of it.
Yeah.
To where you can get right in to the new one without hurting yourself too much.
There's a theory, a rule of thumb out there for a lot of guys that buy rentals that if you're not making 20 to 25%, you're going to be broke on a rental, because if you're not, you got to pay the roof. You got there's major income things that are there.
Now, on that note, there is this is when you have not had the home very long. Okay. So let's say you moved out and you've had this rental property for a while, maybe a couple of years. Now it's a different scenario because we've got to go off of your taxes. It's not that 75% figure. Okay. So let's say you've owned a rental for a year or 2. Okay. And now you're buying another house. We're going to go strictly off of what your taxes show for the income.
Yeah.
So this is where it gets tricky. It's that double-edged sword. For the IRS, we want to show we don't make any money, right?
I know exactly what you're talking about.
For Fannie Mae, we want to show that we do make money.
Yeah.
And so you got to be careful, because if you're writing off too much, that could actually hurt you now in the qualifying of a new loan.
We had a guy, exact same thing. He had bought a fourplex, and he had written so much off in the repairs and everything. He wanted to buy a duplex. He made plenty of money, but he showed a loss on his fourplex. So he had to wait a year and file his new tax returns.
File it differently.
And in order to do that, they couldn't just go off of the signed leases.
Right.
So that was.
So that's a good thing to remember is, if you had it long enough to where it's showing up on taxes, the 75% rule goes out the window. Yeah,
gotcha. So, and I heard somewhere the 75% rule is kind of like they expect you to be 25% vacant. There's kind of some.
Correct. That's why they're kind of why. Yeah, exactly.
Okay.
So.
What about, so you say you've had to do some loans where you've taken over, and I know you've done some for us where someone else couldn't get the loan done. Why is that? So in my mind, I think everything's getting sold to Fannie Mae, Freddie Mac. Why do some lenders able to get loans done that others aren't? Is it that creative financing type thing?
No, that's a really good question. So the way it works is, there's 2 parts. Part 1 we already talked about, inexperienced versus experienced.
For sure.
Okay. You might just have a new loan officer who doesn't know what he's doing, and he literally screwed up.
Yeah, gotcha.
Whereas someone who has experience would have caught the alimony or caught this thing that they didn't know about, right?
Yeah.
So that's reason number 1. Reason number 2, let's say you have 2 competent loan officers that are both following the guidelines perfectly, but one lender still can't get it done. And here's why. There's what's called overlays. Okay, so Fannie Mae says we want this, 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 and this.
Yeah.
Cut and dry. Well, it goes to underwriting, and a different lender may be planning to sell that loan to Wells Fargo. Okay, well, nobody knew this in the beginning, right?
Gotcha.
The realtor didn't know it, borrower didn't know it.
Yeah,
I mean, the lender.
I have no idea.
The lender knew it, but
Yeah.
they didn't tell you anything. And so what happens is the underwriter gets it, and they say, okay, well, you're good with Fannie Mae, but Wells Fargo, they don't like this debt ratio. They're going to trim the fat by 5%. Or they, your credit's 1 point above the minimum. They don't like that. So now you need a cosigner, or now you need to pay this off.
Really?
So that's called an overlay. Just basically means an extra guideline for their fuzzy feel good.
I got you. Above and beyond Fannie Mae, Freddie Mac.
Correct. So that's where a lot of deals blow up at other lenders, and we call them rescue deals. The realtor
You've
calls
done
us
them?
Calls us. No, I'm not kidding. It's
I've done it.
One or two a month.
I know.
We call them rescue deals, and it's always the same scenario. Realtor calls in a panic. Dan, I need a miracle. Our settlement deadline's in 10 days, and this other lender blew up, and we look at it, and if usually that's what it is.
Yeah.
Oh, there was an overlay nobody knew about.
Yeah.
But since we're a direct lender, we don't care. As long as Fannie Mae likes it, we like it.
Gotcha.
Sales through.
Okay. So do you guys buy that loan from them, or you guys just take the whole loan? Meaning, when I don't say buy, when I say because you're a direct lender, do you guys just lend on that one even though and keep that first lender involved, or do you just take the whole file?
Oh, yeah. It would just be
it just comes all over, right?
Yeah, clean
okay,
break.
that makes sense.
So.
And you guys have done that for us before.
Yeah.
Yeah, it's happened. So that's
a real thing.
It's so frustrating when it happens.
And that's good for clients to know.
Yeah.
All lenders are not created equal.
It's true. Okay? It's very true.
And so, if you're going to bobsloans.com with underwriting out of Chicago, you might find an eighth of a point lower rate.
Yep.
But at what cost?
And what you'll find is that I know I'm on my side of the fence here. When I get a loan that the pre-qualification is from an online lender, because I've had so many headaches with them.
And here's the thing:
to get stuff done.
It's all just logic, right?
Yeah.
How are they offering a lower price? Well, the loan officer's probably brand new, making $15 an hour, and he makes a $100 bonus if your loan closes.
Yeah.
How
confident
how
are they?
Into this loan are they?
Yeah.
Right?
Yeah.
Let's say it blows up. Oh, sorry about that. Dang it. Well, it's $459. I gotta go.
Yeah,
right?
exactly. That's exactly my experience.
I'm on a straight commission, and I'm proud of that.
Yep.
I don't make a penny until you're 100% satisfied, keys in hand, in your house.
Exactly.
Right? And you are too.
Yep.
You're on commission too. And so we bend over backwards to make it the best experience ever.
Yeah.
Right? And you might be paying a little bit more. It's not like it's crazy difference,
Yeah.
I mean, we're all almost the same,
Yeah.
But it's so much more than just saving a few bucks, right?
Yeah, and that's been my experience and we now, because of our experiences with them, we didn't know when we first started, but it makes perfect sense. Now we don't. We strongly suggest that we really consider it, because it's such a big deal and it's such a pain in the butt.
Right.
There's no leeway. They have no gray. Right. There's no creativeness. There's no nothing. If it doesn't, they have this tiny little box, and man, if it doesn't fit, just forget it.
And you may not know that until the very end.
And we didn't, and it sucks because the buyer loses their earnest money, or can lose their earnest money at that point. It's not good.
Here's the way to look at it. You went with this unknown lender because they had a tiny bit better price. If you don't get the house, how good of a deal is that now?
Exactly.
It doesn't make
you got 100% of nothing.
Yeah, exactly. It means nothing, right?
Yeah, exactly.
And and one more note on that: in this market, a few years ago, you get up to a deadline, you're like, oh shucks, we need another week. You call the listing agent, all right, whatever. We want to get this thing done.
Yeah.
In this market, good grief.
Yeah.
You go past the deadline, they're like, thank you for your earnest money. Have a nice day.
Exactly.
We got backup offers, right?
Yeah.
And
constant.
so you can't risk that.
Yeah.
That's why it's so important to have a competent lender that's been doing this a long time, that's going to find all those holes in the deal way before it happens.
And fix them. So it's not a surprise.
We never lose earnest money, ever.
Yeah. I've never lose it.
And we always close on time, because that's critical in this market.
It's huge. It's a big deal. Having somebody who knows what they're doing, it matters.
If you want to try to save a buck or two and not have that guarantee, best of luck. But you need to know what you're getting into.
It's sketchy. And that's the thing, when people put in offers, they need to realize that agents look at those kinds of, a competent agent who's been doing it for a little bit, they're going to look at that kind of thing and really advise their clients. Right. We found how many people don't know between the FHA and conventional why you would pick one or the other, and they have no idea.
Here's another advantage to working with an experienced loan officer and a great company. You have no idea how many calls I get from listing agents before they accept the offer.
Yep.
Hey, they're interviewing me.
Exactly.
Hey, who are you? Tell me about this pre-approval.
Yep.
How can I believe what you're saying? Yeah, exactly. The good agents do that.
Yep.
Right. And so, and that's where my credentials come out. It's like, hey, 13 years, top producer. I work strictly with realtors, and so my reputation is everything.
Yep.
Like I am not putting my stamp of approval on that pre-approval if it can't get done. So
exactly.
If I say it'll get done, it'll get done. And they're like, awesome. And guess what? So I actually help you and your client go under contract.
Exactly.
If that was a sketchy conversation with another lender,
well, they sent us their stuff.
I mean, really, which one are they going to go with?
It's so true.
And so I firmly believe that I help the realtors and the clients get into homes. It's just one more little thing.
Yeah, and I think that's just the world-class service that we all try to provide, and that's one of those things that if you don't know what you're doing, you can't provide those things. And so, of course, you're going to charge less because you're probably going to screw it up.
Exactly.
So you got to leverage to get people in.
Yeah.
Exactly. You guys do a lot of programs. Why do some lenders not do these? So like Utah Housing, which is one of these 100% loans. Mm-hmm. Why do some lenders not do those? Like they don't get touched. They don't do anything.
Well, again, coming back to the interview process, Utah Housing is not going to approve anybody. Okay, you've got to be a well-known lender. Have the financial backing.
Oh, so they kind of pick.
They have their own requirements.
Oh, really?
You can't just say, "Hey, we want to offer Utah
Housing." Because you have
a
license to lend. You don't just
Correct.
get. I had no idea.
They have
okay.
their own approval process of lenders. So
I didn't know that.
They're only working with pre-approved lenders. Okay.
Really?
That meet their guidelines, and so and that's just and that's the same with everybody. With Fannie Mae, with VA, with these, they have strict guidelines. Especially some of the government programs like a VA.
Yeah.
We get audited constantly to make sure we're doing our job. And you got to have the financial backing, you got to have the experience, and so again, that could be another red flag. If you have a lender that has two products, it's like, why is that?
Why? Yeah. What's the reasoning behind it?
Are they brand new, or did they screw up on another deal? I mean, really, if
you can get it taken away, right? If you mess it up,
screw up a VA deal, like they'll yank that right out from under us.
Really, and you have to like re-earn it or however you want to call it.
Exactly.
Wow.
So.
That's rough.
It's they don't mess around.
Yeah, which is good, but it's good for the consumer.
It protects everybody. Yeah.
Yeah, it's really good for the consumer. I think that's what all these rules are in place for.
Yep.
Somebody screwed up somewhere. I know in real estate, somebody did something creative, and now we have a new rule that you can't be creative about this.
Right.
It happens all of the time. Absolutely. There's so many things that come along with that. Trying to think if there's anything. Okay, investment properties. You're an investor yourself.
Yep.
What does it take to? So you have your first house. You have your own property. You want to buy something you're not going to sell this house. You're going to buy an investment property. What are the qualifications? What's different about buying that investment property, or even a second home? Is a second home the same as an investment property?
Yeah, really good questions. So if you think about it, you've got to think from the lender's perspective. Okay?
Yeah.
If you have a rental property and your own house with your sweet wife and kids in it, and things get tough, and you don't have enough money for both payments, which one are you going to pay?
Mine.
Exactly.
For sure. Right? Of course.
Exactly. Right?
Of course.
And so lenders aren't stupid. They know that.
Yeah.
And so second homes, investment property, they're naturally considered higher risk loans. Okay.
Gotcha.
So rates are going to be a little bit higher, and qualifications are going to be a little stricter. Okay. So instead of 0 down, instead of 5% down, generally you need 15 to 20% down for investment. Okay. Second home is only 10%. Okay.
And how do you differ those? The people just say I'm buying this as a second home versus an investment.
That's
you know what I mean?
Of loan fraud has happened.
That's exactly, because when I hear that, I'm like, yeah, my second house is rented. It's an Airbnb. I don't ever stay there, but whatever.
Yeah. So, I'm sorry. What was the question on that?
How do you know that it's a rental?
Well,
is that something
that we don't know?
Is that something that the lender or somebody will check up on?
Yeah, oftentimes they will.
I would imagine so, because that's a big deal.
It is a big deal. Yeah, it's loan fraud.
Yeah.
And so here's the basic idea behind that. On a second home, it has to be so far away from your primary residence.
Oh, really?
So let's say you live in Salt Lake. You're like, I have a second home in Provo. We vacation there often. Lenders are going to be like, that's not a second home.
That's a rental.
That's a rental.
Yeah.
Now, Park City. Okay.
Yeah, because that's a vacation place.
St. George, okay.
Even though it's the same distance as Provo, Park City is a vacation resort.
Do you see the difference?
Yeah, that makes sense. That makes perfect sense.
So if it's a make sense deal, obviously we're not going to ask any questions about a second home.
And there's a lot of people involved in a loan. It's not just you as the loan officer.
Right.
There's a lot of people who comb through these to make sure they're right. It's not just one person.
By the time you are signing, many people have looked at that loan.
Yeah, and
just
so
to make 100% sure that it's good.
If there's anything wrong, somebody should catch it in that whole process before you get to closing.
Exactly.
Gotcha. So investment properties, do you guys Airbnb? That's a kind of a new thing.
Mm-hmm.
How does a lender look at an Airbnb if you know that's what the intent is if they're buying it?
If it's well, we don't care from our point of view how they generate income from it. Now, if it's a condo, the HOA might care.
Yeah, for sure.
For nightly rental versus not nightly rental. Okay, but as long as the CC&Rs and the HOA are okay with it, like nobody cares.
We can grab that again.
Oh yeah.
Thank you. Stupid thing. Perfect. Like you're a pro at it now.
But I own several rental properties, and one of them we do nightly rentals on them.
Gotcha.
And so Airbnb.
How do you account that?
That's great.
How do you average? Because a typical rental is a 1-year lease, so now you can average out your incomes on those things. Airbnb, it's who knows, right?
It can be all over the map. And again, it all comes back to taxes.
Gotcha.
So if you have a home that you're doing nightly rentals on, we're just going to look at a 2-year average of what it makes.
Gotcha.
Instead of lease agreements.
Okay.
So.
Gotcha. And then if someone were to buy that to turn it into an Airbnb, they kind of just basically have to make enough money to cover both. Because you're not going to, I would imagine you can't consider Airbnb income as you're buying it like you would 75% of a signed lease.
So if you had a signed lease, we count the 75.
Yeah.
If you're planning on nightly rentals, now you do need to income qualify for both houses.
For both.
Because obviously there's no income.
Yeah.
How do we know who's going to rent it this week versus next week?
And so it just takes a lot of time to build up that stability in order to do something like that. Okay.
Exactly.
Yeah, so that is a question. We get a lot of people, especially because houses went up so fast.
Right.
Mobile homes, like somebody sees one for $30,000. We've done some videos and stuff talking about lot rents and how it's not really that good of a deal.
There's hidden fees, obviously.
Yeah, but why does a mortgage lender not lend on a mobile home? Yeah, they're hard to get loans on. There's no one I know of in state that does them. It's all online.
Well, the easiest answer is which house is going to be harder to move, a mobile home or my house?
Yeah, you mean physically move?
Physically move.
Yeah, that's true.
In other words, the collateral can go bye-bye.
Yeah, that is very true.
Mobile home. I mean, that's one reason. The other reason is by nature, they just don't have the value.
They don't retain value.
Down in value.
Yeah.
It's not considered real property, as you know.
It's a car.
Yeah. It's basically a trailer.
Yeah. I mean, you register it at the DMV. You pay your taxes to the DMV. I've seen one. There was one we were looking at for a friend of mine up here, and when it was new, it sold for like $80,000, brand new, and now it was selling for $40,000 or $35,000 somewhere in there, and they couldn't understand why, and we were just. It's because they don't go up in value. They're not. They don't.
And then this is the thing. I don't want to knock mobile homes. My grandma lived in a mobile home, and it was great. I've got so many awesome memories of it.
Yeah.
And there's a place for it, but as an investment, it's the worst idea ever. It's not an investment. You're going to lose money.
Yeah.
And you're basically a glorified renter. You have no control over that pad rent, what that's going to be.
Yeah.
And
the property
going to go up, just like rents.
It always does.
And so this is a bad investment.
Gotcha.
And if it's dollars that you're talking about, you got to look at the big picture. The borrower may say, I want this because it's $200 a month less than if I bought a house. Well, guess what? In 3 years, it won't be $200 a month less.
Yeah.
In 5 years, it'll be more than the house.
Yeah.
Right?
Most likely, the HOA or lot rent is going to continue to go up.
Of course it will, yeah. And your value is going down. So
I
strongly discourage mobile homes, even if you can find financing for it.
Yeah.
Get a real house.
And by the time you do that, you're the same payment.
Exactly.
I mean, HOA lot rent, a lot of them are $600 to $700 right now, plus $200 to $300. You're $1,000.
Exactly.
I mean, that's $150,000 condo.
Go get a condo instead. So.
Yeah. We deal with that a lot of internet, and it's only because the dollars look so attractive because no one puts the other stuff.
Yeah, if you go to an open house, some of these look great.
Yeah.
You're like, oh man, let's do this.
Yep.
But they don't understand the big picture that you're losing money.
Yeah. And they're hard to rent because a lot of the HOAs don't let you rent them.
Very hard to sell.
Yes.
Try selling one.
They go on the market they can go on the market for a year or two.
I mean, we're talking 20-30 cents on the dollar of what you paid. So.
Yeah.
I do want to mention one more product.
Yeah.
So we have a renovation loan.
Okay.
So 203K loan, what that means is it's a traditional FHA loan.
Okay.
However, they will give you a specific dollar amount on top of the normal loan for fix-up.
Okay, so full repair.
Yeah, so you can say, hey, we found this house, we love it, but oh man, it needs a bunch of work. We don't have the money.
It needs a roof. It's not going to qualify for FHA in current condition.
You might normally skip that house and go show a different one.
Yeah.
Whereas that could be a deal now for you and the client, where they get the money they need. Now they can repair it, fix it up, whatever, refresh it, remodel it, and now it's a deal. So sounds great on paper. However,
I've heard a lot of people ask about it. So, I've never seen one happen.
I've done a handful of them, and they're a nightmare because you're dealing with HUD. Okay. And so you have to have their inspectors. Everything has to go through them.
Do they bid it out? HUD does the bid?
No, you can still use your own contractor, but it has to be a HUD approved contractor.
Oh, wow.
And it's just the longest, most difficult process ever. Okay?
So you have to love the house and location to make something like this worth it.
I'm not saying don't do it, but be prepared. It's going to take a lot longer than you think, a lot more hoops to jump through.
And what do you mean a lot longer? What is that, 60 days, 90 days, 120 days?
I'd say plan on 60 to 90.
Really?
So you've got to have a very flexible seller, too, that means.
Yeah, that's true.
They're tying up their property for a long time, which means they're going to want more earnest money, and a lot of them won't even do it.
Yeah.
Now, so think of all the good of that, and now take away the bad. We have a conventional product that's the same thing, but we don't have to deal with any of that.
You don't have to deal with HUD?
No, not at all.
Wow.
You can use any contractor you want. You can even do the work yourself. Okay.
Really?
And you can get up to 50% of the current home value escrowed at closing for a fix-up.
50%?
50%. So a $200,000 home, you could get $100,000 for fix-up.
Now, how do they qualify that $100,000? Is it something where you're pulling an appraisal on after repair values, correct. And now you can't go above that, right? That makes sense.
Certain areas are going to be better than others.
Yeah, of course.
If you find a fixer-up in Sugar House, you're going to find comps all day long.
Yeah, it's going to be worth a gazillion dollars.
Correct. Or you find maybe a $130,000 condo in downtown. There may not be comps to support it.
Yeah.
So that's the key to this. There are more hoops to jump through because we're dealing with not only the normal lending people, but you've got contractors. Okay. And so I'm not going to say it's
not
simple.
easy.
It's not a simple, easy deal like normal.
Yeah.
But it's a much better opportunity versus 203K.
Yeah, and especially if you love that place.
Yeah.
If that's where you want to be.
I've done a lot of them. It's a great product to know about because buyers that are out looking, it is a tough market with limited inventory. They might start getting frustrated after, hey, we made 3 offers, we got bid out on every one of them. This may be a good product to say, hey, nobody's offering on this one.
Yeah.
Let's go in and just
we can see why.
Exactly.
We know it's a junker.
It's the Brady Bunch house.
Yeah.
With the purple carpet.
Exactly, but you could fix it up and it could be worth that's awesome.
So that's a good product to know about.
Is that something that you would go to a listing agent maybe and say, "Hey, does this house qualify?" Based on what we're willing to sell it for, and ARV is this?
Oh, I see. I mean, really, the listing agent doesn't even have a lot to do with it. Okay?
Gotcha.
Because on their end, it's a normal deal.
Yeah.
Now, they need to know the deadlines. Yeah. I would definitely recommend trying to get 45 days instead of 30.
So it's not a lot longer.
Not a lot
That's
longer,
not bad.
Yeah. And again, we underwrite it as fast as any other deal. It's the contractors.
Yeah, you got to wait to get the right ones.
You got to crack the whip. It's like, I need your bids now.
But I think that you could get listing agents who are saying in their remarks on what kind of loans these are qualified for,
I see what you're
saying so, hey, while we're marketing
let's say it is a fixer-upper.
Yeah, if you
I would definitely offer that. I would say, hey, we have our lender can give fix-up money as part of the loan.
We have one coming on. We're going to talk to you about that because that's one that right now it's a great rental property. Like you could buy it and rent it today, like as is. It's in pretty good shape. But if someone wanted to live there, I think you'd want to update a bunch of the carpet and those kind of things, and that could be a great opportunity for somebody. That's awesome. Yeah. And before you go, one of the things you've talked to me about is on the different kinds of loans that you do is commission-based or self-employed loans that a lot of people so I just bought a car and I'm self-employed and it's been like 2 weeks and the lender's still calling me all this stuff to get stuff done and I'm thinking, guys, this is ridiculous. You guys do self-employed loans and you guys make it pretty simple. Talk about that a little bit. It's not crazy stuff.
Yeah. People get freaked out because I'm self-employed.
Yeah.
It comes back to what we talked about before, the double-edged sword. As long as you're not too aggressive with the IRS, you make $200,000 and they think you make 20.
Yeah.
If it's not that.
Yeah, I've seen that.
Then chances are you're going to be fine.
Gotcha.
Okay, so we are looking at a 2-year average. Now, here's something to think about. Right? A good time for a self-employed person to buy a house is actually right now. Really? Yeah, beginning of the year.
Why is that?
Because they haven't filed their 2018 taxes yet.
Okay.
Okay. So if someone comes to me right now, I have to go off of their 16 and 17 tax. It's always a 2-year average. Okay. Yep. So I have to go off of their 16 and 17 taxes.
Gotcha.
Now, what if they made way more in 18? I'm going to tell them, wait until you file. Like, call your accountant right now and let's get those things filed, because now it's the 18-17 average.
Yeah.
And that could be the difference between a $500,000 home and a $300,000. If someone had a much better 18 than 17-16.
But if someone had a great 16, they can go now.
Exactly. What if
and they don't have to file.
Yeah, what if they had a crappy 18?
Yeah.
Well, let's do it before April.
So it's April 15th is kind of the deadline.
So let's do the 16-17 now.
That's great.
So,
I'm going to clip this little part because this I know a lot of people who are self-employed. Right. A lot of guys who are general contractors who are doing their own thing. That makes a lot of sense. Now, is it 2 years of self-employment tax history you need, or if they started a year ago, they need 2 years?
That's a really good question. So self-employed, like true self-employed, has to be a 2-year average. Okay. Now, commission income, this is back to those overlays. A lot of lenders still say we want 2-year history of commission. Fannie Mae actually only wants 1 year.
For someone like myself who is
Absolutely. So if you get, well, let me put it this way. If you get a W-2 in your straight commission, 1 year. Okay.
Gotcha.
If it's 1099, that's still considered self-employment.
Oh, okay. Yeah, so I'm 1099.
Yeah,
I'm
so
1099.
so most realtors are going to be 2 years still.
Okay, that makes sense.
But car salesman, for example, W-2, straight commission. Okay?
Gotcha.
And a lot of sales jobs are that way.
Yeah.
W-2 straight commission. So we only need 1 year.
That's awesome.
And that's a Fannie Mae guideline, but other lenders are going to say 2 because that's that overlay. They want the extra protection.
Okay. Gotcha.
Yeah. Well, actually, one final note. Great time to buy right now.
Yep.
Just so you know what's going on in the economy. I mean, everyone kind of knows, but here's from a lender's perspective.
I think a lot of people think they know.
Yeah, exactly.
How's that?
Let me tell you from a lender's perspective what's happening, okay? So we've talked about the crash 10 years ago.
Yep.
What happened was, we literally thought it was the end of the world.
Yeah.
Everybody did. The Fed came in, dropped rates to never before seen levels. Ridiculous. 3% rates on a house. And why did they do that? It's back to what we talked about before. What do you buy when you buy a house? The next thing, stuff.
Yeah, you're trying to instigate the economy.
Sorry. Okay. So spending creates more spending and builds the economy, right?
Yeah.
So they knew that if we can get a lot of people into houses, this is going to help tremendously.
Yeah.
So rates go to rock bottom. All these people are buying houses. They even had, if you remember they'll give you $10,000 as a tax credit to buy a house. Like they were just pushing so hard to get people to buy houses. Well, it worked. Everybody started buying. Why would you rent when you can buy for less?
Oh yeah,
right.
So a lot less.
Tons of people buy. Real estate prices start going up. Everything starts getting better. Unemployment starts coming down. All of these benchmarks, stock market recovers. So all of these benchmarks that they tried to fix are now fixed.
Gotcha.
We've got stock market, it's been hitting record highs. Unemployment's back to record low, right? So what do you think is going to happen to rates?
They got to go up.
Obviously, we say they're going up and people freak out, but they're not really going up. They're going back to where they should have been. They never should have been at 3%, right?
Yeah.
And we're not even back.
Not even close.
Once we're in the 6s, now we're...
It has to happen, right? When we get
Once
close
we're
to
in the 6s, now we're back to pre-crash rates, right? So when we say rates are going up, they're really just going back to normal. Okay?
Yeah.
But you need to know that affects your buying power. So,
for sure.
Yeah, so if you wait till next year versus this year, you're not getting as much bang for the buck.
And you think that, and they go up slowly. It's not like overnight we're going to be at 6.
They go up slowly, but let's say they're going up consistently.
Yeah.
9 quarters in a row, the Fed's raised rates.
Yeah.
And they don't intend to stop.
No. And that's been... The Fed, when they raise the rate, it's not necessarily a direct impact to lending, but it happens.
Rate, correct, but everything else,
it's going to happen from it.
Everything else, naturally goes up.
When that happens, everything else is going to go up. Okay, got it.
So, bottom line, if you're even thinking about buying a house, call Andy and Clint, and
let's get going.
Even just to have a conversation.
Yeah.
Because if you wait a year, you wait 2 years, even if real estate stays the same, you're going to pay more.
Yep.
Now you add in the real estate. What if prices keep going up?
And they are.
Now you've got a double-edged sword. You've got rates and prices going up. You're going to pay more later than now. And that's not a sales pitch. That is a fact.
It just is what it is.
And so talk to everybody now. Give you guys a call.
Yeah.
Have a conversation. At least know what your options are.
Yeah, and there's no risk.
Exactly.
There's no risk in talking.
And even if you're a year out, now you know what your plan is.
And that's one of the biggest things is we incubate people for a long time because they're scared to talk to anybody, but once they find out how simple, right. I mean, it's work. You have some expectations, but it's simple to get this done. Yeah. So that's awesome.
That's the long-term projection. Uh-huh. Now, short-term, the rates do fluctuate. In fact, they have actually come down the last month or so because of all the government shutdown and all this stuff.
All the volatility scares everybody.
Fear in the market is good for rates.
Yeah,
that brings them down. So now is a really good time.
Yeah,
like today.
Yeah, and a lot of people could refinance. I mean, they got the whole deal, pulling equity out to buy an investment property.
Yeah, great opportunity to do something now. But if you wait too long, we're going to see things keep going up.
Gotcha. So. Sweet. Well, thank you, man.
Yeah. Thank you.
Wait. We have to answer one question.
Okay, absolutely.
Someone asked. I actually got a question off of Facebook.
A listener question. All right.
Yeah, we do have to do this one. So she wanted to know more about construction. Let me read this. She said, "Love to know more about construction loans. Is there different down payment options on construction loans? Why is there so much cash that's needed? And do lenders want to see a higher credit score with construction loans?" So we can hit those. Okay. First one, different down payments.
Excellent question. So, again, the easiest way to understand these things is flip it around.
Yep.
Think from the lender's perspective, okay? So we talked about investment, how they're higher risk. Mm-hmm. Construction's higher risk too, and here's why. You start building a house, and you lose your job. They don't want a half-built custom house, right?
That's true, yeah.
So they're going to require more skin in the game. So if it does go south, well, now they're selling this custom house to someone else who doesn't want a custom house, and they've got a cushion, right?
Yeah.
So more down payment naturally required, okay? Same thing with credit. It's the whole picture. We want a more solid borrower that we think is a less chance of bailing out on this thing in the next year.
Gotcha.
Versus a traditional deal where you're in it in less than a month.
So is that kind of a typical construction loan is a year?
Well, it depends.
Okay.
6 months to 12 months is pretty common, depending on location and builders and all kinds of stuff.
Gotcha.
Now, if you're going with a big builder, that's actually the easiest way to build a house. Yeah. Is they're just going to require a deposit.
And they only have so many options and customization.
They carry the loan, and then when you buy it, it's just a regular loan like any other. But like you said, the flip side is you don't get a customized.
It's not as customizable as they're going to make that neighborhood the same, so that if you can't perform, someone else is going to want to be in that neighborhood.
Exactly, but we can still get creative. Let's say you own a home now, you can pull out a home equity line, no cost. Use that for the construction loan deposit.
You're like a HELOC kind of thing?
HELOC, exactly.
Oh, okay.
And so those are considered acceptable funds.
And do you guys do those?
We don't do them in-house. Well, let me take that back. We do offer them on a purchase.
Gotcha.
But not on a refinance.
Okay.
But we have connections with some great people that do that.
Awesome. So just let us know.
Yeah, we take care of you no matter what.
Cool. Cool. Because I know a lot of people that are talking about doing HELOCs in order to buy investment properties. Because the difference between a HELOC and refinancing, the main difference from what I understand, and correct me if I'm wrong, is this the HELOC, you're not paying on it until you spend the money.
Correct.
The refinance, you get the cash in the bank. Now it's yours. Exactly. The HELOC, you get a checkbook and you write a check. Now you're paying on just what you wrote the check on. And is there different percentages of amounts you can get?
Yeah, home equities, again, it's all risk-based.
Yep.
Home equity is considered higher risk than a traditional first and second mortgage. And so higher rates, okay? And oftentimes they're variable too.
Oh, so wow. We've
got rising rates.
Yeah, that could be bad.
Be careful with HELOCs. It's still a great tool if you're disciplined.
Gotcha.
So in my opinion, because I'm an investor, if I'm pulling money from a HELOC to buy another house, I'll do it all day long.
Gotcha.
But if you're not disciplined, it's basically the world's biggest credit card. And you can get in trouble.
Yeah, and now you've guaranteed your home. Exactly. A credit card's not guaranteed.
Not your home,
now you've guaranteed your home.
So a HELOC, think of it like a sword.
Yeah.
Used properly, it's a great tool.
Yeah, or not.
Let's say Who has a sword anymore? Let's say a knife.
Good point. I was thinking
a
medieval
sharp
times.
knife is a great tool unless you're not careful with it. You can get hurt.
That makes sense. Well, man, thank you so much for coming down. I really appreciate it.
No, that was great. Thanks for having me.
I'd love to have you. We're going to, if it's okay, have you back, and I'm sure we're going to have other things that happen in the market, and we'd love to stay doing these things on a regular basis. So,
awesome.
Sweet.
Thanks so much,
man.
Andy.